Let me start with you, Sharmin. You have your outlook for 2022 out. I picture right now the cover. You have an icebreaker going through some really perilous waters here with a lot of icebergs. Tell us what you're concerned about for U.S. equities going into 2022.
David, the purpose of our cover is actually to make sure that our clients can just look at the cover and know what the key message is. And the key message is an icebreaker. It's a U.S. Coast Guard icebreaker that we've called USS Equities. And it's going through all these icebergs, hence the term piloting through. And our view is that U.S. equities are best positioned to pilot through all the risks. And the icebergs are labeled according to the risks we know are inevitable in a year like this. So the biggest iceberg out there is first inflation. Then the next iceberg is interest rate hikes. And much further out, we have the prospect that maybe we're going to have a recession. But there's some icebergs we've passed through, like Omicron and big energy prices. And so the recommendation to our clients is that stay invested, and we're calling it USS equities because we're emphasizing US equities. But let's recognize all the risks out there that we think will introduce a lot of volatility, as you said, but will not derail the economy or derail modestly positive returns in equities. We still recommend staying invested because we have about a 6% total return as our base case. So certainly a lot of volatility, certainly risks that we have to navigate, but something that we think is manageable for 2022.
So now to continue the analogy here for a moment, it did feel this week sometimes in the markets like it was an icebreaker zigzagging around some of these icebergs. And two of them, as we heard from Sharmin, were rate hikes and inflation. Tell us about those jobs numbers that came out, stunned a lot of people on Friday. Does that send a signal to the Fed, you got to raise your rates even faster and even more?
So, those jobs numbers, we have to recognize that we have seasonal adjustment factors playing into these jobs numbers. So the jobs numbers, the participation rate numbers, actually, it's not very clear what they're telling you. You talked a little bit about the revision, David, to December's numbers. There was also a revision to November's numbers, largest revisions on record. However, if you look at the year as a whole, some numbers were revised down. It's seasonal adjustment. So, what you actually take away from that is a little hard to see. What I'm taking away from the entire report really is that 5.7% wage increase number. And then if you look at non-managerial, you're looking at 6.5. So you're looking at really strong wage growth. That's the number which I am focused on. And if I look further and think about inflation next week, I think that I would start getting worried if we got that upside surprise to what is broadly expected to be a 0.4-ish style increase, which will give you a headline of over 7%. But I'd say that's where my concerns would be about the Fed speeding up, but it would have to be in conjunction with that inflation number.
Sharmin, I don't know about you, but when I hear wage increases, I think two things. Number one, it's nice for the people getting paid more money. That's really good. On the other hand, it can do something to margins for corporations. Does it give you any pause at this point going into 2022 about earnings?
When we think about earnings, we believe that they have been the strongest driver of the returns since the global financial crisis, and they will also be the primary driver of returns in 2022. So our base case is about 12% growth in earnings, but we are, as you point out, assuming that we will see some reduction in margins. U.S. margins have grown steadily since China joined the WTO for a whole host of reasons. And the increase in margins has continued to surprise investors because everybody looks at them and say at some point they have to be coming down. But what has actually transpired is margins continue to increase. We think we're probably going to be closer to the peak, and we're going to see some margin compression, a little bit coming down because of exactly the point, wages. And as Sonal mentioned, the wage increases, the pace will be a little bit stronger. And we're going to probably get a few inflation numbers that are going to be a little bit strong. We think people are expecting them, but it's always hard to know what the market reaction is when you actually see the print of the higher numbers. But yes, we are assuming some compression in margins, but still pretty good, robust earnings growth.
Hey, Sharmin, do you think that the companies are going to be able to pass through more of these price increases as we go forward? Because as you pointed out, we also think that the underlying economy is going to be pretty strong, because that's one of the things which I'm monitoring quite closely to see how much we see companies trying to protect their margins by passing along price increases to customers.
Well, as we've just briefly touched upon, these things are a double-edged sword. So on one hand, price increases allow companies to increase their own prices and maintain good revenues. On the other hand, you also have higher cost of inputs. When we look at the history of earnings, generally companies do absorb some of the increase in costs into their margins. So I think it would be unrealistic for us to assume that all the increases, including energy prices, are totally passed through. Our view is that they pass through some, but not all, and they do absorb some into margins. And that's why we do think you're going to see a bit of a decrease in margin levels.
So Donald, to come back to you on fixed income. Okay, maybe the markets can absorb some of this cost increase, wage increase. How much of a rate increase can the markets absorb? I mean, we went up to over 1.9. People are talking about something significantly more than that, perhaps driven by the Fed, who has to get, don't they have to get real rates up above zero in order to really control
Someday.
inflation? Yeah.
They absolutely have to. And the reality is, I have actually been quite critical of the Fed's, the route the Fed has taken on this. They already established in December that inflation had surprised them. It wasn't the type of inflation they wanted. We heard from the Fed just a week ago, where they did announce that yes, the taper was going to end, and they were going to making very clear that we were going to have earlier rate hikes, but they're still expanding. The taper will end in March, but with the inflation prints we're seeing, with the strength of the underlying economy, they haven't actually stopped buying. So we are still seeing an expansion in the Fed. So I'd say that overall, the Fed does need to do more. Will it do more, and can the market absorb it? I think they have noted they want to be very measured. I'm not absolutely sure that the data is going to allow them to be as measured as they would like. This is a dovish Fed in the end, and I don't think they will have the ability to be as dovish as they would like.
So now let me go over to Sharmin on this question. Does Sonal's part of the world actually potentially affect yours in this sense? As she says, sooner or later, they got to stop actually pumping money into the economy, and they said they're going to start taking it back out. How much are we seeing an effect of the withdrawal of liquidity at this point in the equity markets?
David, one of the interesting parts of our report is that there are a lot of myths out there that actually aren't quite accurate. So the argument that this incredible bull market is all liquidity driven is actually not correct. Half of the increase that we have seen since the trough of the global financial crisis, so let's say returns around 760% cumulatively, is driven by earnings. We have about a quarter of that remaining being driven by dividends, and the remaining quarter is driven by multiple expansion and lower rates. So one could say that there's been some impact from lower rates and liquidity, but the biggest driver has actually been earnings. That's what's so incredible about this market rally. And this earnings has been broad-based. It's also a myth that technology's driven all of it. It's actually very broad-based earnings.